We're starting with capital budgeting today, corporate finance. So we will just get started with the topic, and then once we've solved a couple of case studies and you've got a good hang of how level 2 is going to be, then we will discuss schedule and how to study and all other things related. So let's get started. So some basics of capital budgeting is the purpose of capital budgeting is to take the whole idea of this exercise is to
decide whether project is feasible or not. Decide whether project is feasible or not.
Page number. So capital budgeting is to take decisions primarily about the business related investments. And then at L1 we looked at some of the metrics which we use for taking decision. So if you remember, we learned to calculate a number called NPV. NPV was net present value, and it was calculated as, correct me if I go wrong, present value of outflow minus inflows minus outflow. So present value of inflow minus present value of outflow. And the typical decision rule was that you should accept the project when NPV is less than 0, NPV is greater than 0. And if there are 2 or more projects, then you would select the one which has higher NPV. Then we also learnt about a number called IRR. IRR was what? Internal rate of return. And how should we think of this number? The rate at which NPV is 0, fine, but that doesn't help me understand. Fair enough. So IRR is the rate at which NPV is 0. But so she's saying it is the return that we earn on a project. Is she right? Yes. So it is the return that we earn on a project, not considering which cost? Financing cost, correct? And then we compare IRR with what? Cost of capital. And you would want IRR to be lower, IRR to be higher. So when IRR is greater than cost of capital, automatically what we know is that NPV is going to be positive, correct? So that's how we take decisions based on IRR. Then we also did look at a number called PB, payback period. So time taken to recover your initial investment. Did we also look at discounted payback? Yes. So again, the time taken to recover investment, but considering time value of money. So how do we calculate PB and DPB? Using the NPV function, we calculate these. And did we also learn profitability index? So this was calculated as present value of inflow divided by present value of outflow. Now the good news for you is that level 2 syllabus kind of picks up from where we finished at level 1. Okay, so it is a very smooth transition of what you did at L1 and what you're going to do at L2. Now think of the kind of questions you solved at L1. So in L1, they gave you a set of investment that you did at inception. Then they told you what were the cash flows that you were expected to earn, and then you calculated NPV. So more or less like this. Now at level 2, what you would really be doing is you would be the one deciding what is the true initial investment required. So I'm sure you know by now that level 2 comes in a case study format. So now they will give you a series of transactions or activities happening in that case study, that you are considering buying a machinery. The cost of machinery is this, but if you buy the machinery, you will have to increase your working capital. There would be installation cost. You would have to recruit additional engineer. So you will have to decide what is that initial investment. Then they will say if you buy the machinery, it will increase your revenue by this amount, but it will also increase your cost by this amount. Right? So which means your profits will increase, but your taxes will also increase. So you'll have to figure out what amount of cash flows is going to increase every year, and then based on that you'll have to do the NPV calculations. Okay. So there are certain rules that they've given. These are those 5 rules. I want you to write them down, and they're kind of repetition of level 1, but we get to apply them now at level 2. Are you done writing this? Okay. So first point, can someone help me understand why? Okay, one is he said accounting income is on accrual basis, and he said accounting income might have non-cash items. Okay. Accounting income can be manipulated, yes. So again, the idea is, if you remember at L1 I said that we have to think like a baniya. So those of you who don't know who baniya is, just Google for it. So we think in terms of how much cash came in and how much cash goes out, and therefore we are concerned about cash flows. Second, opportunity cost. What do you think? People around the pillar. Other opportunity is there. Okay, anyone else? Cost of next best alternative. Okay, so think of it this way, that you already have a piece of land on which you would like to set up a factory. So you're doing a capital budgeting decision. Now technically you don't have to buy that piece of land, isn't it? Because you already have it. But if that is the case, should that be considered as a part of initial cash outflow? The answer is yes. Because if you decided not to use that for the project, you might do something else with it, and that would generate you some amount of cash flow, correct? So therefore we say that you also should be considering the opportunity cost. Timing is important. Why? Because we need to discount the cash flows. After tax basis, because your profits might increase but your taxes will also increase, so we look at taxes. And last one, do not consider financing cost. Tell me why. Financing cost would be like interest. So why should we not consider financing cost? Yeah. So, but why not consider? So my question is, imagine I'm doing a project. So let's say I want to get into a equipment leasing business. Okay, so I'm going to borrow money and buy equipments, Khushbu. And then if I borrow money, I will have to pay interest. So interest is a true cash outflow for me. मेरे जेब से पैसा जाने वाला है. So then the question is, if I am paying interest, why not consider that while making capital budgeting decision? Yes, it is considered while using the discount rate. Are we together on this? It is considered while using the discount rate. Okay. Now, these are some of the steps through which we are going to solve case study. Don't write this. Now, see, some of the case studies on the face of it would be very intimidating. Okay, they would look really big and they would have a lot of data in them. So I have pulled out 2 of those case studies. We'll be practicing them. So the strategy for any capital budgeting case study is that you break it down into smaller parts. Okay, which parts? So first, read through the case study and figure out what is the initial cash outflow. That is your step number 1. That means at time 0, what is the amount of cash that's going to go out. And when you do that, make sure that you consider increase in net working capital. Okay, so what is this? Imagine you decided that instead of the existing equipment, you want to buy a more larger size of the machinery. But if you do that, to support for that, you will have to have additional level of inventory with you. That means your investment in working capital will increase. So that investment in working capital is also a part of your initial cash outflow. Are we together here? So that is your step number 1. Then step number 2 is find out what cash flows you are going to generate during the life of the project. Now, at level 2 exams, typical time span that I have seen is about 5 years. Okay, so during those 5 or 7 years, how much cash you are going to generate. Then find out when you shut down the project, how much cash you are going to generate by the end of year 5 or year 7. So you would sell off your machinery, and all those things. This is where consider these two things. Number one, taxes. So you bought a machinery for 50,000. You charge depreciation of 40,000. So now what is the book value? 10,000. So that 10,000 worth of asset, if you sell for 12, your profit is 2. Your cash flow is 12. On that profit of 2, you will have to pay taxes. So your net cash flow would be 12 minus the amount of tax that you pay. Are we together on this? Also consider net working capital. So when you shut down the project, whatever amount you had invested in working capital, that might be released. Okay, so most of the cases they will give you a percentage ratio. We typically say that 70% of the working capital is released. What it means is, if you had invested 10,000, and I hope you're listening carefully because you're going to solve one immediately. If you've invested 10,000 and if the release ratio is 70%, that means you will be able to recover only 7,000. So technically that 3,000 is a loss. That 3,000 is a loss. CFA curriculum is silent on whether that loss should be used for tax purposes. So we will decide that on a case study basis. But just remember that working capital is to be released by the end of the project. And then once you have these three numbers, just put them into cash flow function, clear prior memories, and you're good to go. Are we okay?